Welcome to the Rotary Club of Hudson. My name is Evan McCauley, president of the club, and we are thrilled to have you joining us today. This meeting broadcast is available on HCTV as well as our Rotary of Hudson YouTube channel. Our club meets weekly at Laurel Lake for breakfast on Wednesday mornings from 7:15 to 8:30 a.m. Come out and join us for a meeting. We'd love to have you as a guest. To learn more about Rotary, our club, and the impact that we are having on the local community and world, please visit rotaryhudson.org. Enjoy the meeting today and be the inspiration. Good morning, everyone. Welcome to the Rotary Club of Hudson. How is everyone this morning? Woo!
I'm thinking that might be what.
Okay, thank you. Perfect. Well, we're going to kick off this morning with our invocation with Phil Warburton.
Good morning, Rotarians. Would you bow your heads, please? Help us today to see our opening prayer as a conversation, really believing you hear us and care about what we say. Remind us that you are a perfect Father who listens carefully to his children and desires the very best for us. We thank you for this family of Rotarians for which we belong, and ask that you bless us as we meet together. In Jesus Christ's name, amen. Amen.
And to lead us in song this morning, Tom Tobin. Get this, there's a story. So I realized that Chris wasn't going to be with us this morning, so right when this thought hits, first person I see is Bob Crampf. So I say, hey Bob, who has a good voice in here other than Chris? Immediately, Tom Tobin. So without further ado, Mr. Tom Tobin.
All right. Do the pledge.
How about the pledge?
I'll do the pledge too. Okay. I'm a utility field. Will you join me in saying the Pledge of Allegiance? I pledge allegiance to the flag
of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
And the four-way test of the things we think, say, or do. First,
is it the truth?
Second,
is it fair to all concerned?
Third,
will it build goodwill and better friendships?
Fourth,
will it be beneficial to all concerned?
All right, good. All right, so you don't get the hand motions with me. You get the loud voice. What would you like me? God bless America.
How about this land is your land?
Oh, we can do that. Let's do that. All right. 3, 2, 1. This land is your land. This land is my land. From California to the New York Island. From the Redwood Forest to the Gulf Stream waters. This land, it was made for you and me. As I was walking that ribbon of highway, I saw above me the endless skyway. I saw below me that golden valley. This land was made for you and me. All right.
That was beautiful. All right, our sergeant in arms is not here this morning, as you know. I'm working through the agenda, but let's calm down out there. Today we have a couple of guests with us, so it's a special day. Guests of Rich Warfield, we have Eric Parker and Casey Johnston sitting back there with Catherine Stein. So welcome. Thanks for being with us. Wonderful. So I want to just roll through a couple things here. Not too much going on, so we'll get right into our presentation this morning and leave plenty of time for question and answers. People of Action campaign, I mentioned this in my Rotary reminder. There's a really cool tool out there on myrotary.org. Basically, you upload a photo and you get to, pick a couple of inspirational words to add on there. What I'd like to do is I'd like to gather all of your awesome photos, your favorite Rotary moment, and we'll make a nice collage with that. We'll include it in our brochures and some other club material. So if you have any good photos, feel free to play around with that, or go ahead and send them over to Jay or myself, and we'll have some fun with it. As many of you know, we've got a YouTube channel. Let's get some more traction with that. Share that with your friends. Subscribe to it. Check us out. You can go on there and make fun of the president for missing parts of the agenda, etc. Speaking of that, this is very fitting. Let's go back to this here, today's agenda. So it's a funny little cartoon that I found, and it's pretty hard to read, but it says, "The mind is a wonderful thing. It starts working the minute you're born and never stops until you get up to speak." So, I was just searching around cartoons, and that guy looked a little bit like me, so I thought I'd make fun of myself this morning. So coming up, we've got a couple of excellent speakers lined up, Mike Ramito, and then I'm really looking forward to having the EMS chief and the chief of police here, Chief Jerry Varnes and Chief Tabak. So share those events with friends and family members that might be interested in coming out and joining us. The Club Runner mobile app. Can I get a raise of hands if you have downloaded the Club Runner mobile app? We're growing traction. It's pretty good. You're easily able to call a Rotary friend or look at the events that are taking place in our club just with the click of a button. So I'd strongly recommend, if you're interested in staying up to date, that you download that app. And I mentioned this at Camp Manitowoc last week. Thank you to those of you that came out to the camp. It was a wonderful meeting. We had great breakfast and toured the facilities out there. So thank you to Patrick for being our sponsor for that event out there. But the event that I was talking about is a Browns fundraiser. This is through our district, 6630. Basically, at these home games, October 7th, November 4th, and December 9th, you go up there a little bit earlier before the game. You get suited up in 50/50 raffle gear, and you stand there with your little mobile device, and you sell 50/50 tickets, and people absolutely have a blast with it. So if you have children that might be interested in joining you, or if you'd like to take part, you can register on the district website, or you can just send me an email and I'll help you get signed up.
Does that
Jay?
include tickets to the games?
That does. So you don't have to pay for tickets, and they wrap up sales usually right before the fourth quarter, so you can stay and enjoy the end of the game, really. Good question. Does anybody have any updates or announcements other than Ed Sogan this morning? All right, Coach.
You can stay for the Browns victory party after the fourth quarter. A tie. Oh, jeez. Just a couple of quick announcements. The Hudson Athletic Hall of Fame will be held October 12th and 13th. The induction is on the 13th. It's a breakfast. And then all of our Hall of Famers will be introduced in the auditorium immediately following the breakfast. Our inductees this year, we have two state championship teams, our 2002 girls soccer team and our 2002 boys state championship soccer team, and our 2007 girls softball team will be recognized. Along with these individuals, Lauren Echo, our 100-meter hurdle champion, Craig Boyette, who was the MVP in all three sports in golf, basketball, and baseball, Alex Gideon, the oldest Gideon brother, and he was a football player and a basketball player for us. Joe Caniglia, a current football and wrestling coach for us, participated in both sports in high school. Rob Yanko and Chuck Schilling, coaches. Rob was our golf coach, Chuck Schilling, football and baseball. Paul Vaggi, who continues to be a big part of Hudson Athletics in regards to his service to all the programs. We have Jim Buxton, our own Bob Hills, Gasper Lococo, and Doug Hasbrook will be recognized as members of the Booster Club that built Lavelli Stadium back in the early 70s. They started the Booster Club in the 60s, had many, many big projects, but this was the biggest one. And two of the guys are 90 years old. Bob is celebrating his birthday this month, and the other one's 85, so it's a pretty exciting time to have them there. And Matt Eisenberg, who was an All-American in boys lacrosse. The tickets, you'll find them on our Hudson City Schools website and on the foundation website, Hudson City Schools Foundation website. You can do it with PayPal, or you can send a check in to Post Office Box 473 in Hudson. That's our Hudson City Schools Foundation. They're $20 for the event, and for children under 12 to 3 years old, it's $10, and that will be held again on Saturday, October 13th, to recognize those individuals. Another thing to put on your calendar, it's never too early to start planning, Santa on the Green, December 1st. Have a great day.
Ho, ho, ho. James Field.
Morning, Rotarians. This will be real quick. In between sports activities, we actually have the kids do some school, and no, actually, but we got a preliminary look at our grades now. We're not super happy with the state grading system because it really doesn't look at all the aspects of what you do for kids from sports and the arts and so forth. But given all that, Hudson did get an overall grade of an A, and I think it's, as we like to say, it's really a total community effort. It's obviously the kids, teachers and staff, the parents, but the whole community, and Rotary is obviously a big part of that with all the work that Rotary does with the school. So thank you, and just wanted to pass that one on.
Thank you, James. Yeah, absolutely. Jim Young.
Good morning, Rotarians. Joe Boisel, Father Joe, was supposed to do the invocation this morning, and I got a text about 4 o'clock yesterday afternoon. His mother has had a stroke. It was at Kittering, and he asked if we'd keep her in our prayers.
Thank you. Are there any other updates or announcements for the good of the group? All right, then we're going to move into our presentation today. The topic is wonderful. I love it. It's the world that I live in, managing your personal finances. And with this room, we've got a number of advisors and bankers and folks in the financial world, so it'll be very educational. And for those of you that are not in that world, I hope that it's very informational for you. So we're going to have Joe Avella come up and introduce our featured speakers today.
Good morning. Good morning, Joe. So our theme this month, as you saw the speakers, it's we don't have a name, a theme name, but it's interesting things you should know. Protecting your wealth, managing your health and your safety, and then planning for the end. So with Mike Ramito. So that's pretty much the theme, things you need to know. But we're pleased to have two speakers with us this morning. Greg Box is a Rotarian. He's a partner in the wealth management group of TPG Wealth Management at UBS Financial Services. He's a former practicing CPA, as well as a practicing estate planning attorney. He obtained his undergraduate degree from Canisius College in Buffalo and his Juris Doctorate from the University of Akron. He and his wife Susan reside in Hudson for almost 25 years. They have 2 daughters, Katie and Maggie, who are students at Hudson High School. And Paul Corbeil is also a partner with TPG. He has over 28 years of industry experience and is one of 2 senior portfolio managers at that company. He was awarded the Certified Portfolio Manager designation from Columbia University back in 2014. He heads up the individual equity analysis for the team and co-leads and selects the investments. He's a graduate of Ohio Wesleyan, and he and his wife Susan reside in North Royalton and have 2 children, Katie and Christopher. So please extend a warm Rotary welcome to Greg and Paul.
Good morning, Rotarians. I get to speak on estate taxes, and the only really word to describe it is riveting. So we'll get right to it. There we go. Okay, so I think the best way to start is just kind of give a brief history of where it's been so you can compare it to where we are today. If you go back to the 90s, which I think probably most of you remember, maybe not Evan, but if we go back to the 90s, the stock market was on a pretty good run. And if you look back for federal estate tax purposes, the exemption back in the 90s was about $600,000. And it had been there for a long, long time. And so what that meant was the federal government would give you the first $600,000 to pass on down to the next generation, and then they would start taxing you. And the tax rate was 55% was the top rate, so pretty onerous tax. And it really didn't take that much in the 90s to get up to 600,000. You take a look at, your retirement assets, equity in your home, non-retirement assets, life insurance proceeds. It didn't take much to hit that 600,000. So a married couple back in the 90s could safeguard 1.2 million, and the primary vehicle for doing that was doing these living trusts, AB trusts. How many of you are familiar with the AB trusts? Sure. So fast forward, Bush comes in the office, and we start finally getting some increases in that 600,000. It then proceeds on up through the years. And, by 2017, we were looking at 5.5 million, so a dramatic increase. So a married couple could then save, in 2017, a married couple could save $11 million, basically, from before you start getting taxed and estate taxes. And the rate dropped from 55, the top bracket, from 55 down to 40%. So again, a big change. The other thing I should mention, in the 90s, we also had a Ohio estate tax, and that basically capped out at about 7%. So again, a lot of taxes were being paid. Now Mr. Trump comes in office, and we have our tax bill, and he basically, I think the initial intent was to get rid of estate taxes altogether. There may have been some self-interest there, but the end result was he doubled the exemption yet again. So now we're up to 11 million and some change per individual. So a married couple can now safeguard $22 million worth of assets. The long and short is, not many people are filing federal estate tax returns anymore. And I think in 2017, the number was out of approximately 2.5 million estates, a little over 11,000 filed an estate tax return. Out of those 11,000 estate tax returns, about 5,500 had to pay some form of tax. So again, very small percentage compared to what it used to be. So now the one caveat with the new tax laws, there is a sunset provision that takes place after 2025. So just like the Bush tax cuts, the sunset provision would let it go away. Now, what happened with the Bush tax cuts, it didn't go away. So, it's going to be largely dependent upon who is in power at that point in time, whether it's the Democrats or Republicans is my guess, as to whether or not the sunset provision actually takes place after 2025. Now, the other thing is we don't have to worry about this, like I said. Ohio got rid of their estate tax in 2013, but there's still about a dozen states that still have an estate tax. And there's, I think, 6 states that still have an inheritance tax. State tax, the estate pays, the inheritance tax, the beneficiary pays. And I think one state, Maryland, has both. So they kind of get you on both ends. The gift tax annual exclusion has now gone up to $15,000. And I don't know if you know what that is, but basically the government has allowed you to take a freebie. So you're allowed to give $15,000 a year to anyone you want without any sort of gift tax or income tax consequences. So each of you could write me a check for $15,000. I will gladly accept and no tax ramifications whatsoever. Probably one of the more interesting changes over the recent years has been portability. Just curious, anyone's familiar with portability? Okay. Portability is, it was introduced in 2010, and it refers to the ability of the surviving spouse to make use of a deceased spouse's unused estate tax exemption amount. So what that means is, again, back in the 90s when everyone was doing AB trusts, because the idea was you had to split that AB, you had to have a trust so that you could fund upon whichever spouse passed away first. You wanted to fund it up to, say, $600,000. The balance would roll over to the surviving spouse, so you could get 2 bites at the exemption amount. What portability would have been a great tool to have back in the 90s, because one of the problems we used to have is we put these trusts in place, and if you're in a traditional household where usually the husband was the breadwinner, you'd have all the assets on his side, and you had to somehow try to equal out the asset. And it was sometimes difficult to fund the wife's version of the trust. And so sometimes if she were to pass away first, you wouldn't get the full benefit. Portability would have made that so much easier. We wouldn't have had to worry about that. Now, going now with using portability now, again, with an estate exemption amount being $11 million per person or $22 million for a married couple, it really doesn't, come into play as much. It would have been a much nicer tool to have in the 90s as opposed to now. The biggest thing probably about portability is it creates some other issues in the form of basis. With what we've got, with all these AB trust plans out there, portability kind of gives a little issue with the basis. And the basis, I guess the only benefit of dying is you get a stepped up basis in assets. So if you had the insight to buy 1,000 shares of Apple back in 2002, you would have spent a little over $23,000. Today that would be worth about $2.6 million. So you have a large capital gain issue. If you were to pass away with those same shares today, the nice thing about it is you get a stepped-up basis. In other words, that capital gain is eliminated. It's the gross portion is part of your estate, but again, the capital gains goes away. So the problem we have now is we see a lot of AB trusts out there where, because the exemption amount is what it is, the wording on most of those trusts will say the trust for the first spouse to pass will be funded up to the amount of the available exemption amount. Again, currently $11 million. So most people who die with a AB trust in place, they'll get a stepped up basis in that credit shelter trust or the exemption trust. And then if the surviving spouse passes away 20 years later, you've got that capital gain that'll build from the time of the death of the first spouse to the death of the second spouse. And, whereas with portability now, because you can just basically elect to use the unused portion, carry it forward to the death of the surviving spouse, you'd get a stepped up basis at the death of the surviving spouse, a full step up. So you would pass assets on down to the next generation without any capital gains issues. So it's something I think to look at if you currently have AB trusts in place. It makes sense to go back and take a look and just see whether or not that's still the way you want the plan, or maybe you want to make an adjustment. Because there's still a lot of reasons to have a trust carved off at the first death, depending on the particular situation. So I think that's something to look at. Whoops. So, in terms of estate planning today, what do you really need? I think these are, at least you want those 4 documents. You want a will, you want a durable power of attorney, a healthcare power of attorney, and a living will. The will, for the most part, it controls the distribution of probatable assets. So a probatable asset would be something that is in your name individually. You don't have a beneficiary designation to it. You don't have a transfer on death or a TOD associated with it. That has to go through the probate process to be distributed to your beneficiaries. Durable power of attorney, I think, is a great idea for any, especially between husband and wife, and really anybody. And again, the healthcare power of attorney, which basically says that if you can't make healthcare decisions for yourself, you're passing that decision on to whoever you name. And then the living will is basically a declaration saying that if you find yourself in a situation where you'll be kept alive artificially, 2 physicians basically saying that it's an irreversible condition, you're making the decision when you sign the document to actually, you want the plug pulled. So again, those are at a minimum is what you should have. And the question these days, again, with portability and what have you, is do you need a trust? And I think a trust still makes sense in a lot of reasons. Larger estates, certainly, there's planning that's usually involved. For control purposes, the shift from the 90s when the emphasis on doing trusts was to minimize or eliminate the estate tax, now it's more for control purposes. And that really depends on the family situation. So if you've got, in this day and age with addiction being what it is, or you just want to make sure that the kids maybe before they get a windfall possibly, they want to be mature enough to be able to handle those type of things. You can either set dates for distribution, or you can actually just hold it in trusts permanently. The increase of the trust also, when you use it in conjunction with the durable power of attorney, healthcare power of attorney, it does set up a situation where you can possibly avoid guardianships, which again, you kind of take the court out of the equation, streamlines the situation. And of course, avoiding probate, which is simply titling things in such a way. It's just another way of avoiding probate. There's also a couple other things. Privacy is something that if you're, again, it's private, it doesn't go through probate, it's not public record. So people, I think that makes, again, some sense. And probate, what is probate? Well, I mean, it's really the process of, for those assets considered probatable, again, owned in your name individually, if you were to pass away with those type of things, you file the will with the probate court, you file an inventory, distribute the assets, and ultimately file an accounting. And again, the process can take, it usually takes about 9 months to a year to wind it up, but again, it's public knowledge, public record, and it's not the worst thing in the world, but again, it can be avoided. And the ways to avoid it, again, trust, titling assets. Usually you see this between a husband and wife, joint tenancy with rights to survivorship. You see that a lot of deeds. Beneficiary designations associated with IRAs or 401ks. Transfer on death is another way of doing it, which is just, it's basically acting like a beneficiary designation. And then with the recorded affidavit, and I put that one in because with real estate these days, you can actually record an affidavit which acts like a beneficiary designation. Record it, it bypasses probate and goes directly to your beneficiaries. And the next part is for Mr. Corbeil.
Thank you, Greg. Good morning, Rotarians. Good morning. Good morning. This is my first meeting with you all, and I just want to make sure that I clarify one point of record on the introductions. Greg Susan and my Susan are two totally different people. I want to appreciate and express some thanks for everybody hosting these events and inviting me to attend this particular morning. We're just going to go through a few basics with regards to the stock market, the bond market, diversification, and the like. But there's a couple of key points that I want to make that I think, regardless of how simplistic some of these slides might be, the point that we want to make with regards to how you invest your money and how, what types of things to consider really have to do with time frame and patience. And I think that that's the key point that we want to take away here. I'm not going to spend a lot of time on some of these slides, but stocks, you own a piece of the company that you're investing in, and bonds, you are a lender to the company that you are buying bonds from. They each have similar goals in some respects, and others, very different goals with regards to the risk and reward of those types of securities. This is a chart, and if you get to know our team at all, you will know that we love charts, and we figured that the more stuff we put on a chart and the more confused you are, the better off we've made that presentation. So what we're going to try to do here is put together just some historical data with regard to the stock market, the bond market, and the bottom line with regard to the different types of securities within those asset classes. Small company stocks going back basically 92 years here, okay, have outperformed all other assets at the top line right there. Inflation is this gray area, so essentially all of the different asset classes over time, whether it's treasury bills in the green, government bonds in the red, large company stocks in the blue, or the small company stocks at the top, have outperformed inflation over the long period of time that is depicted in this chart. This is a more recent chart, but it basically just looks at the last 20 years of the same asset classes, and you can see small company stocks have outperformed at the top of the chart there. Large companies, government bonds, inflation actually, has cut into the returns on treasury bills, and everybody in the last really 10 or 15 years understands that you're not getting any type of money in a money market in a short-term CD. Even if inflation's at 1% and you're getting 0.5% on your savings, in actuality you're losing money, even though you're not actually seeing a drop in the portfolio value that you have in those securities. But that's another way to slice and dice the effects of inflation. The last 10 years, as I mentioned, again, stocks continue to outperform, but I want to kind of point a little bit here to this area right here in 2017-ish, 2016 to 2017, where small company stocks really didn't go anywhere, and large company stocks have really been on a tear of late. And I always have used this chart to kind of explain why that is that larger companies have outperformed small companies of late. Again, if you're not earning any money in your bank accounts or in certificates of deposit or in government bonds, and you simply want to pursue a return that is reasonable at 4 or 5, 6%, and you sit down with your advisor, whether it's us or whether it's Evan or anybody else, and you say, how am I going to get a return on my money? Well, let's talk about the stock market. Not so fast. Well, it's the only way you're going to get long-term growth in this interest rate environment. And with the Federal Reserve Bank keeping rates so suppressed for so long in an effort to resuscitate the economy on the heels of the great financial crisis, or the Great Recession and the global financial crisis, a lot of people who normally don't invest in the stock market have kind of been coaxed into getting it because they've seen since 2009 this little rally here that has really been significant. So if you're going to take that step and say, okay, I'm going to get into the stock market, are you more likely to do it with Microsoft, Apple, Amazon, Johnson & Johnson, Procter & Gamble, or are you going to, dip your toe into some stocks that you've never heard of? Okay, so we really have looked at this thing in the terms of what's gone on with interest rates. And the green line here, what you're earning on treasury bills, 0.3% a year over the last 10 years, and said, okay, if I'm going to take that plunge, I'm going to do it with companies that I know. Well, we think obviously the long-term trend is that people should diversify outside of just large company stocks, bonds. They should also incorporate some companies that they maybe they know because they're a local company that they're a little smaller, but they're not those household names that you see broadcast on CNBC at 4 o'clock every day. Okay. When you look at other asset classes in commodities, real estate, and gold, which is actually a subset of commodities, you can look at things and say, okay, real estate over the last 38 years, 38 years, has actually been the best place to be over the long haul. Okay, but it is interest rate sensitive in a rising rate environment. You can look at that and say, okay, interest rates start to go up, they start to chip away at my dividend yield, which is something that you see from real estate that pays a decent amount over and above what other asset classes would do. And you start to say, okay, I still need to be diversified into the other asset classes. This is what I talk about with regards to time frame. And what we're really looking at here is 1-year returns at the top of the chart. Generally speaking, you have a 26% chance that you're going to lose money from 12 months from today. Okay. If you hold that investment for 5 years, that shrinks to about 14% chance that you're going to lose money from the beginning to the end of the 5-year period. And over a 15-year period, you can see the chances historically over the last 90 years, 92 years, 100% chance that if you hold your money for 15 years in that stock investment, you are going to make money. Now, the next 15 years, nobody knows. We can't sit here and say the next 15 years I can guarantee you, because the chart says so, that you're going to make money, but the odds are with you. Okay. Bond market. High yield corporate bonds that are investment grade, companies with stronger balance sheets are come in second over the last 32 years. Government bonds are third. They're not that far behind at 8%. Municipal bonds are at 7%. Treasury bills again lead, the bottom of the pack, but at 3.2%. But that's, again, we're comparing to some extent apples to oranges here. Treasury bills are notes that come due in less than 12 months. Treasury notes are 2 to 10 years, and Treasury bonds are 10 to 30 years. Okay, so you can probably look at this over the course of a 30-some year period and say Treasury notes and Treasury bonds, just like your CDs, if you go out longer, you should get a higher rate of return. You should get a higher rate of return on those. But they just simply look at this as a proxy for cash, as Morningstar illustrates here. So we're really looking at things from a standpoint of, the high yield market. Again, the higher the risk that you take. These are bonds that are issued by companies that aren't the greatest. Right now, U.S. Treasury debt is a AA+ rating. You can be considered what's called investment grade or lower risk bonds as long as you maintain a BBB rating. And anything below that, BB, single B, triple C, are more speculative. But again, the higher the risk, the higher the reward. And we're in a position right now where you're not getting enough, in my opinion, in yield on high yield or junk bonds for the risk that those offer, and especially if rates start to continue to go higher. I really caution every one of our clients and anybody who will listen to me talk about this is just because it's paying us 5, 6, 7% yield doesn't mean it's the best investment for you to consider. Because the higher the yield, and if rates start to go up, you're going to end up in a position where you could start to see on your statement principal losses. And this is exactly what we're talking about with regard to what's going on with rates. Interest rates have dropped over the last 45 years. There's the peak where you were getting 15% on bonds. Okay, when I first got in the business in 1989, I was a shareholder services representative for a mutual fund company, and anybody who had anything in a money market fund was getting 8, 9% interest. Now if we can get 1.5 to 2% on a money market, we should be considering ourselves lucky. But the point of this slide is as rates go down, bond prices go up. And the whole premise of that is if rates are going down, the bonds that I bought 2-3 years ago are worth more money because the new bonds are being issued at lower rates. And the exact opposite happens when rates start to go up. So you can see here, in the climbing interest rates and the hyperinflation of the 70s, bond prices were falling like a rock. This is probably the most perplexing dilemma for everybody in this room with regard to how do I diversify my portfolio? How do I manage this in a rising interest rate environment? If you're telling me, Paul, that if rates start to go up, my bonds are going to start to fall in price. And we all know that if you hold a bond to maturity, 95% of the time you're going to get your money back from that BBB, single A, double A credit. Okay, and again, the high yield chart from the previous page shows, you know, that you've got to take some ups and downs with it. So we really have to take a look at how we construct bond portfolios much more carefully than we ever used to. And so over the last 10 years, when you look at average inflation, okay, investment grade corporate bonds still have a nice spread over inflation, as do long-term government bonds. As you start to get in the shorter end of the yield curve, in other words, you know, the shorter maturities, intermediate term bonds don't have nearly the spread over inflation. And this is a 10-year average of 1.6%. Right now we're sitting at a 2.2119 range of inflation. And the fears are that if wage prices continue to go up, you're going to start to see more inflation pressure. Okay, so that could eat into some of these other shorter term government bonds returns. Bonds obviously produce more income historically than stocks, and here's a 48-year history of looking at a portfolio of all stocks. 26% of that portfolio is going to generate dividend income. The rest of this green area is going to give you price growth, hopefully. Okay, you mix in a portfolio of bonds, 74% of the bond income is coming from the interest off of it, and maybe you're going to get about 21% of your return from the appreciation of the value of the bond, okay? But that's capped. That upside on a bond is capped. Even if you buy a bond at 95 cents on the dollar, when that thing comes due, it's paying $1. So you've got limited upside, okay? And then a little bit of reinvestment of income is you know, obviously going to add to your total return of the portfolio. When you add a bond portfolio to diversify your mix over, again, the last 48-year period, you can sit here and say an original portfolio that is simply all stocks, or 70% stocks, and 30% cash, okay, has a return of about 9.8% a year over the last 48 years, and it has what's called a standard deviation or a risk measure of 12%. So you can see 12% fluctuations any given year, up or down. And we all love the 12% up. Anybody raise your hand who doesn't like 12% up? Anybody raise your hand if they don't like 12% down? You must be one-year investors. When you mix in a little bit of a portfolio of bonds to the portfolio here, and you've got a 40% mix to bonds, your return over the last 48 years has still been over 9%. What has happened is your risk number has dropped to 9.8. So again, this is a 48-year period here. This is not to simply say 48 years going forward or the next 12 months going forward, but you get the point with regard to how do I continue to get returns, and it is continually based upon how long can I afford to leave this money in my investment account. It's not how old you are. It's not, the two things that we do to measure risk in our group, when the market's down, like it is this month so far, who's picking up the phone and calling us? Those people are slightly more adverse than the people who are simply saying, hey, this is just the way it goes from time to time. If I stick with it and I do 5-10-year periods, I'm going to be fine, okay? The other thing is that how long is it going to be before I need that money? If you notice, the third thing might be, how old am I? Might be. If a client who's in the above the $11.2 million single lifetime exemption amount. Is that the correct term? Whatever. Okay. Got a nice pension, getting Social Security. He's got $12 million sitting around, like we all do, right? And at the end of the day, that client is most likely giving their money to either charity, family, or they're going to be doing something else with that money and not spending it. Okay, their time horizon may not be how long they're going to live. Their time horizon is how long is it going to be before the people who are going to get my money are going to spend it. So what we try to do is make people rethink risk in terms of their time horizon, but thinking sometimes beyond their own life expectancies. Okay? Because that can then help you build a portfolio that makes sense for the goals that you might have set aside. Risk and return, stocks, bonds, and bills, T-bills. Again, this is just regurgitating. This chart I love because everybody chuckles when I say I love this chart. And if you would talk to one of the other portfolio managers on our team, Jim Urek, he would say, this chart is really cool. Okay. All this is each color, and you look at it historically from 1998 all the way across to 2017. This is what's called a periodic table. Any science people in this room? Is this the periodic table?
Something.
Doesn't have a bunch of elements on it, okay, but it's got returns on the portfolio subsets, small company stocks, large company stocks, international. Here's what's going on. Right now, international stocks are down 4%. Here's the one thing that individual investors, the biggest mistake they make is they look at what happened last year and they go, that's where I got to be. International stocks were up 25% last year. They outperformed every other asset class. People were getting excited about what was going on with the global growth recovery. Europe was finally on board with keeping up with the United States as far as GDP, or getting closer to it. And all of a sudden, come April, May, June, President Trump starts talking about tariffs against EU auto exports, everything else. And so now all of a sudden, the U.S. is again the prettiest house in the neighborhood, okay, leading the way, and international is down 4%. What we do is we say get a mix of all of these, because international investing has paid off more times than it hasn't. But if you look at things isolated in a given year and make that the template for making your decisions for the following 12 months, you got to ride that out, and you've got to live with that decision sometimes. So in our portfolio, we're, when we manage our portfolios for clients, we're revisiting what's going on with our international exposure, and we've got an underweight to the asset class. But the point is, if you own every single one of these assets in your portfolio, small company stocks all the way down to treasury bills, the gray area is the diversified portfolio. How many times is the gray area in the bottom performing asset class? Anybody? It's not. It's always in the middle, and that makes sense because it's basically an average of all of them. This is a little bit of a busy chart, but basically this is long-term bonds. Again, 1 year, 3 year, 5 year. Anybody got a sense of the theme of this thing? Time frame. How long can you invest? An aggressive portfolio, again, which is mostly stocks, a little bit of bonds, in a 1 year period, has about an 8% chance of losing 10% or more. Go down the list, 1, 5, and 10 years, and look at the zeros of losses. Again, historically, but again, investing isn't about getting a guarantee, it's about putting the odds in your favor. Conservative portfolio still has a chance of losing money in a given year, more than 10%. Especially right now with bond rates being so low still, and as bond rates go up again, prices of those bonds go down. So if a portfolio is extremely conservative, because hey, I'm a conservative investor, I don't want the stock market, that portfolio is going to be more than 50% bonds most likely. So you, again, going back to my point earlier, you have to really be careful as to how do you construct a bond portfolio. And now this is the only slide in which I'm going to read every single no, just kidding. But I want to thank you for your time. I hope this was helpful, and at this point, I think we're going to go to a couple of questions if there are any. So feel free to fire away on topics that Greg or myself covered. Yes?
Are you seeing shifts in the portfolios? Are you seeing any shifts in your portfolios from the 60-40 to maybe a 65-35 blend because of the poor return in the bond market right now?
Did everybody get the question? Are we seeing a shift in the traditional 60-40 because of people not wanting to be as reliant upon bonds? We are encouraging, and I'll take that and widen that portfolio out a little bit. The more conservative investors to be a little bit less reliant upon bonds, but we've actually looked to build our bond piece of those portfolios differently than simply just the bond index. The big question then becomes is if equities start to really have trouble, it's entirely likely that we think traditional bonds will outperform and start to make money again. So we do think the construction of the bond piece is more important than avoiding bonds, if that makes sense. Buy bonds with, go bonds, go global. You can still get 4 and 5% dividend yields on a mutual fund that's diversified. Bonds with shorter maturities, higher interest rates, but they become a little bit more sensitive to the stock market in that regard, and that's the tightrope that we have to walk as portfolio managers. But yes.
Currently, so many funds are flowing into the vanguards of the world and finding their way to the ETFs and the indexed funds and so on. Is the world wrong, or should you stick with the basic portfolios?
There are 3 very dangerous words in the investment world, and they are, it's different now. I've been in this business for 28 years, and we've seen the rotation from active to passive that you're talking about, where people just say, set it and forget it. Vanguard is the leader in index investing, okay? But here's the thing. Through August 3rd, 2/3 of the return on the S&P 500 was 6 stocks. And you can guess where I'm going with this. Facebook, Amazon, Google or Alphabet, and Apple. Netflix was out of that. Has anybody heard of the term FANG stocks? Okay, Facebook, Amazon, Netflix, Google, or which is now called Alphabet. So the answer is that yes, to my point with regard to large companies, that's mostly index funds. Okay. How many of you walk into your advisor or you go online and say, I want a small cap index fund? How many people go and look online or walk into their broker's office and go, talk to me about Facebook, talk to me about Amazon, talk to me about Microsoft, talk to me about Apple? And we own Apple in our active portfolio. I'm probably one of the only portfolio managers that I would guess bought Apple and Winnebago in the same week. Okay. But so the answer to the question is yes, we're seeing huge inflow. But one of the things that it's an interesting thing that we look at. We watch flows on all equity funds, mutual funds, index ETFs, everything else. And we watch the flows. And generally speaking, when money's coming out of stock pooled investment vehicles, we consider that a positive indicator in a 30 metric composite that we look at every morning to gauge how much should we have in stocks. And when money's flowing out of those indexes, and it's about 4 million, it's not huge, it's $4 billion come out in the last 4 weeks average. Because again, people People's sentiment is fickle. Well, if the market's losing money this week, I got to pull my money out. And they're more likely to do that from index vehicles because there's generally not at the other end of the line somebody like us that's going to sit there and say, take it easy, hang in there, let me tell you what we're seeing. Okay, so we use that as a bit of a contra-indicator how much money's flowing into those, because at the end of the day, anybody who's looking at reversion to the mean says if small company stocks over the last 5 years have underperformed large, but over the long term they've outperformed, there's some catch up. It's just like the marathon runner. Some people get it out of the gate quick, and other slow and steady wins the race kind of a thing. So we look at this, but the key is to have both. But we think that there's a tide turning towards more active management because unfortunately it's underperformed because everybody's been pushing. But when things really get dicey, in 2000 and 2001, small company stocks are right here in this dark blue, 22.8%. This is the tech bubble, right in the throes of it, okay? Down 3.6. Large company stocks were down 9 and 12 over that same period of time. And then they were down 13. We actually saw in 2000, 2001, small company stocks make money when the Cisco's and the JDS Uniphases, okay, and anything with a .com on the end of it, were losing money significantly. So it's all about patience, and it's all about, yes, we expect a rotation. Yes?
On a slightly different subject, if you were talking to your average client and they asked you, what is your opinion of long-term care insurance, what kind of advice do you give?
The opinion of?
Long-term care insurance.
You want to take that?
Yeah. That's yours. Long-term care has, it's interesting, it's changed a lot. I mean, you know, it is costly, especially depending on when you start looking at it. Statistically, if you look at it, men just don't seem to last very long in those type of facilities. That's just the way it is. So a lot of times when we have clients that come in and they're considering it, we'll actually sometimes put it on the wife as opposed to having it on the husband. The other thing is the industry has changed a lot too because their numbers just quite frankly didn't work out. So there's a lot of companies that are getting out of it. And they've changed it a little bit. Instead of just having where you can have the premium per se, there are actually companies coming out and taking, it's kind of a combination of quasi life insurance. So we've had some people with life insurance policies that have fairly decent, significant cash values coming in, replacing the policy, and it becomes kind of a long-term care / life insurance policy. So there are some other options to look at these days, but again, the numbers, you know, it's kind of a very personalized thing where you come in, you take a look at the numbers and kind of make a decision whether or not it makes sense or not. But there are a lot more options out there today. I don't know if that answers your question or not.
That's fine.
Thank you.